The idea of an economic soft landing is a fairy tale told by liars and believed upon by fools. Hi, everyone. This is Mike Wilkerson, and this is the Stormwall Advisors monthly update for February 2024. I want to get into the idea of a soft landing and whether that is meaningful and what's going on with our stock market and the economy. But before we go too far, if you're watching this on YouTube, please be sure to give it a share and a like, subscribe to my YouTube channel, and pass it along. Again, I'm Mike Wilkerson. I'm the founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. Let's jump right into this. I want to do this by talking a little bit about some of the recent events that we've seen in the markets and the economy. I'm going to be sharing my screen to do so, and let me just make sure that I can do that. I think we got it. And so here we are. So we're sharing. So coming into February, we're at a point where we've now seen the markets hit an all-time high. So recording here over the weekend after the first week of February, just last Friday, the S&P hit an all-time high, and this was the highest level since 2022, but higher than even before the pandemic and lockdowns. And indeed, the president of the United States, President Biden, tweeted yesterday saying, "Good news for folks as we start the weekend. The stock market going strong is a sign of confidence in America's economy." Well, I want to get into whether all of that is true or not. But one of the things I've noticed in the last really several months is this focus on the idea of a soft landing. The markets are clearly desperate to believe that it's all going to be fine. So there have been multiple stories, almost reading off of the script, the narrative around the soft landing is coming into view. It's coming into view, where to look for it, what it looks like. And it struck me that this is a strange coincidence. So I did a little Google research on trends and terms, and it turns out that so here we are in 2023. This blue line is the searches for soft landing, and this red line is this term Goldilocks economy. Both of them are relevant. And what you see is this soft landing is more popular than ever. And in fact, we've never seen any more references to it than we did in the years prior to the 2008 financial crisis, which is about here where I'm pointing. If you're just seeing an audio, imagine that big spike right before the 2008 crash, and usage now is actually about a third higher than it was then. In those years before the 2008 financial crash, there was a lot of talk about the Goldilocks economy, this idea that interest rates were very low, that unemployment was low, that financial innovation and productivity was high and growing, and then this stark run up in talking about the soft landing when everyone was very concerned about, hold on, we're now seeing all these problems in the banks and the financial economy. Can the Fed navigate? Can the Fed get us through this? And what we see is that this was almost became a mantra, became a chant in the years right up before 2008. And I think we're in a similar phase right now. So I wrote an article a couple of weeks ago, about a week ago, I guess, called "A Soft Landing is a Fairy Tale," and just noting that the use of this term has spiked, and the last time we saw that was right before the financial crisis. So I argue that the markets and investors are in a state of denial. And that denial has a couple of key elements. One is the conviction that the Fed will soon and substantially lower the Fed funds, the target interest rate, from where it is right now at 5.5% on the upper limit. Well, that's point number one. Number two, the belief that the fight against inflation has been won. Declare victory. We can move on. Inflation's been beat. We can go back to normal. Two. Three is the complete disregard by the markets of the truly catastrophic fiscal position that the U.S. government finds itself in, with nearly $2 trillion of deficits, piled on deficits, 21, 22 trillion since the year 2000. At this point, over 34 trillion of federal debt, which is ticking at about $1 trillion plus of interest cost to service that debt. For just the general blind faith acceptance of government data on employment and the economy, which I've argued in previous episodes is complete nonsense, that the data are not real. And we'll talk a little bit more about that today. And then just to summarize, the market has been reacting as if good news is good news. I wrote it wrong on the screen, but if good news is good news, then bad news is also good news. And so whether the news comes in as something positive or something related to escalation of war or some other crisis, the market still tends to go up. Now, one of the facets of this is investor complacency. So the markets are not pricing in risk at all. We see one measure of risk is called the VIX, the S&P, the volatility of the S&P 500 index. That is tracking towards a nearly all-time low, one of the lowest levels that we've seen. And it simply does not reflect the risk in the market. And it implies that the market doesn't believe that there's going to be a correction, that there will be a soft landing. This to me is just foolishness and total complacency on the part of the markets, or the index itself is being manipulated, which is also a possibility. Now, just this week, Federal Reserve Chairman Jerome Powell threw cold water on the idea of certainly on the idea of interest rates being lowered anytime soon. So just as a reminder, since the first part of 2022, the Federal Reserve has raised interest rates 11 times, and the target interest rate now sits at 5.5% on the upper bound, highest level in quite a while. Not unprecedented or abnormal over the long run, but certainly in a lot of investors' minds and lives, something new and troubling. And so there's been this desperate desire to believe that these rates are going to come down. This is a bit of a busy chart, but I just want to explain what we're looking at. This is the target probabilities where the market expects interest rates to be at some point in the future. In this case, we're looking at September 2024 Fed meeting. Just a month ago, at the beginning of January, if you look at what I'm looking at here, the circle, there was over 70, nearly 80% of the market expectations that believed that by this time, interest rates would go down from 5.5, where they are right now, all the way down to at least 450 basis points or lower. So in other words, if we take the center of where expectations were, the market was pricing in, call it 4% interest rates instead of 5.5 by about 8 or 9 months from now. Following Chairman Powell's comments, those expectations shifted, and we see the center of gravity is still expecting a significant reduction of about 100 basis points to 450, i.e. 4.5% by September. But certainly there was a reset in investors' minds as to how quickly these interest rate reductions were going to come. Nonetheless, the markets went up, share prices continued higher. And this, in part, as I mentioned, is on a belief that inflation has been vanquished. It's been defeated. Well, this is not true at all. We saw the most recent reading. We'll get another one in a few days for January, but for December, headline inflation actually rose from November's 3.1 to 3.4% in December. And more fundamentally, core inflation, which excludes food and energy, came in at 3.9%. Basic, let's call it 4%. That is significant and nearly double where the Federal Reserve would like to see inflation. So as I've said repeatedly on this channel and in my writings, we're not done with inflation. It is still there. It's persistent. It's likely to make a strong comeback. And I also have been arguing that the U.S. economy is not nearly as strong as the narrative portrays it. We see a lot of evidence, in spite of a GDP print at 2.9 in the fourth quarter and expectations of roughly 2.5% GDP growth next year, that GDP statistics are also misleading, if not being manipulated outright. And that expectations from business leaders is actually much worse than what those are showing. Now, I've been fascinated this year by Zero Hedge's coverage of the government jobs data, because Zero Hedge has been relentless in pointing out some inconsistencies in the headline numbers of the government reporting versus what private sector jobs data are showing from sources like ADP and others who track jobs data from the private sector. But just this week, Zero Hedge came out with some other interesting details. One made the point that since a year ago, since February of 2023, all the job gains, like 100% in the past year, have been of part-time workers, and full-time employment has actually gone down by about 97,000 people. One. Secondly, that the job growth, all of it, has gone to foreign-born rather than native-born, i.e. Americans who were born in this country. All of the jobs have gone to foreign-born workers, whether legally immigrated or otherwise, and that effectively the jobs gain for native-born workers since July of 2018 is zero. There have been zero jobs created for the native-born. The inverted yield curve that we've seen persisting for over a year and a half confirms a bigger problem, which is the best predictor of recession. So an inverted yield curve is what happens when, let me just back up for a second. In normal times, the yield curve should steep upwards. In other words, the cost of long-term treasuries, like a 10-year treasury, should be more expensive than the cost of a 2-year treasury because there's risk in the future. People have views about getting money today versus getting money 10 years from now, and the cost of lending out money for a longer period of time normally is more expensive than the cost of lending out money over a short term. That should be obvious to everybody, that if I said to you, look, I'll give you $1,000 in 2 years or $1,000 in 10 years, which is more valuable to you? And of course, with uncertainty in life and everything else, it's just normal to value consumption and having money to spend on consumption sooner than later. Well, that's not been the case. So for the last year and a half, since the fall of 2022, the yield curve has inverted, meaning that the interest rate on short-term treasury bills and notes has been higher than the long-term treasury of 10 years. And in fact, it got quite steep, over 100 basis points at a couple of times in 2023. It's narrowed a bit now, but still remains negative. What does this mean? So an inverted yield curve, as far back as the data goes in the 20th century, has always been the best predictor of recession. There are a lot of ways to test and see, is a recession likely or unlikely. Inverted yield curve has always been the best measure. But it's important to note that it's the best predictor with a lag. And so typically recessions have followed somewhere between a year and 2 years, or 18 to 24 months after that inverted yield curve. So if we look at when the yield curve turned upside down in the fall of 2022, and it's been negative this whole time, we're now hitting at that 18-month point. If you go to the steepest part of the inversion, that was in the spring of last year. So we're about 12 months out from the steepest part. So I argue and believe very strongly that recession is coming. It certainly was delayed from when I and many others thought it was going to come, but nonetheless, we're still on the path. Okay, so I wrote an article last month called "The Banks Are Not Okay," actually at the end of December, and this was put out not just on Stormwall.com, but the Epic Times, and was picked up by Zero Hedge as well. And my main thesis here is that the banking crisis that we saw start in 2022 is far from over, that we still have warning signs and big problems. I'll go through this quickly because I did cover it last month, but just as a reminder, since last year, or since I should say 2022, the U.S. banking system has lost $1 trillion in deposits that have gone from the banks into money market mutual funds and other places where investors have been able to get more money. Over the past few quarters, even though the deposit flight has slowed, the deposits have not come back, and they continue to move outward and drain bank funding. This is terrible for the banking system. And you can see it in the fact that the banks are now turning to the government to borrow money. So the Federal Home Loan Banking System, which is a system, government system within the U.S. to support U.S. banks, they lend to the banks in times of stress and emergency. They've been borrowing in the bond market over a trillion one in 2023. Why? Because they're borrowing because they are lending to the banks. The banks are borrowing from the home loan bank system in order to shore up their deposits because they're not able to fund it in the market. We've also seen the banks reporting massive unrealized losses, up 22% in the third quarter to over 684 billion. We talked about that last month, and we talked about the banks sitting on a record number of unrealized losses. Well, now at the end of January, we're seeing what I've been saying would happen, which is the beginning of what I think is going to be round two of the banking crisis, which is, in this case, New York Community Bank. So New York Community Bank was the acquirer of Signature Bank that failed last year under regulatory pressure. Fail may not be the strict term, because basically they were shepherded into the arms of New York Community Bank by the regulators in New York. NYCB also bought Flagstar Bank earlier, and now is suffering, kindly put, a bit of indigestion from both. So in the fourth quarter, they announced a $252 million loss. They cut their dividend by 70%, which is never great if you're a bank or a financial institution where your investors are expecting that, both as a sign of health and because they rely on that yield. And they reshuffled management. The market really puked this up, did not like it at all. The shares fell by as much as 60%, erasing 4.5 billion of market value from NYCB's stock. The next day, Moody's, the credit rating agency, came out and downgraded NYCB to junk. Now, this is a terrible sign, because banks have to fund in the markets every day. They have to roll over short-term debt. And in my experience and my understanding of history and my professional experience, no bank, none, can survive as a non-investment grade, i.e. as a junk rated company. That's not what banks are there for. They're there to not be speculative. They're there where bondholders, investors can rely on them. So I believe that whatever happens with NYCB, and I'm not optimistic, I believe that this is the beginning of a second wave that's going to come in 2024 of potential bank failures, and that this is the problem. And one of the issues, and again, I mentioned this last month, is that the bank use of the emergency funding program the Fed put in place, which is called the Bank Term Funding Program, BTFP, is at an all-time high. In fact, from last month, when I said it was at an all-time high, it's hit a new all-time high. And as of the end of January, there was over 165 billion drawn by the banks from the BTFP at the end of January. Not good. This is not normal market operation. So here we are back in January, where the program started. Even when SVB had failed, and in March of 2023, the banks were in crisis, they were borrowing 40, 50, 60 billion. Today, 165 billion. Now, one of the reasons this is problematic is the program is ending next month in March of 2024. So when the Fed authorized this, they said publicly that they're putting the program in because of the unusual and exigent circumstances in the banking sector, i.e. the fact that there were massive deposit runs. Now, if it expires, what happens to that 165 billion of funding? Well, if that program is allowed to lapse, and I don't believe it will for a reason I'll explain, then we're into another immediate liquidity crisis in the banking sector. And that would be very free market like, is to let the chips fall where they may. But we know from experience that the government, the Federal Reserve, the Treasury, the administration, the Biden administration is not going to let that happen. And so I believe they will renew the program. The question is on what terms. It's an admission of what I've been saying, which is that the banks are not okay. In other words, are we still in unusual and exigent circumstances in the banking sector? That's effectively what this would be implying. Now, a little detail from the Fed's most recent meeting: the Open Market Committee's text actually deletes a phrase that has been in previous meeting transcripts, which is the statement that says the U.S. banking system is sound and resilient. That statement was deleted in the most recent meeting of February 1st or 2nd of the Open Market Committee of the Federal Reserve. That is extremely telling. Okay? The Fed is now quietly admitting that the banking system is not okay. It is not sound and resilient. But there's even a bigger risk, which is that the banks are one thing, but we have this entire shadow banking system, the non-bank financial institutions outside of regulated depository institutions that lend money into the markets, into mortgages, into everything else. It is the bigger problem, perhaps, and the trigger. These shadow banks, or I shouldn't say banks, shadow banking system have over $1 trillion, 1 trillion with a T, dollars of assets, financial assets, loans, etc. This is problematic in part because it means that the banks are now double levered in a sense, in that they have exposure to the broader financial system outside of the banks. In particular, what I would say is you can see this and if you look back at what happened in the global financial crisis in the years before, it were these non-bank financial institutions that were the first to go. Back in 2006, 2007, when the commercial paper market dried up, where these institutions were getting a lot of their funding, the CP market failed, the commercial paper market failed, and these banks, or these non-bank financial institutions, began to fail as well because they couldn't get the funding and they couldn't get banks to lend to them either. Well, now the shadow banking system is even larger with over $1 trillion, as we mentioned, and they rely primarily on the banks for their funding and on prime money market funds that then lend on to these institutions. So just as what happened in 2007, 2008, I think the tell here will be if one of these prime money market funds breaks the buck. In other words, they're no longer able to maintain $1 value per share. That will be the sign that this crisis is in full swing. So we're going to wrap this up. I just want to leave you with a few takeaways. It's a pretty serious message. It is a warning message. The takeaways are that, one, we are in a speculative bubble. The markets are unrealistically pricing in a soft landing. They're expecting an interest rate reduction and the end of inflation both to come much more quickly than it is likely to. The real economy is not as strong as the narrative. Employment and GDP stats, employment data and GDP stats are deceptive. The banks are not okay. And I think it's important to underscore that March and April may very well be the tipping point with the risk we see another round of bank failures. Now, a banking crisis would, of course, easily become a broader credit crisis, including through the non-bank financial institutions, the shadow banking system. But similarly, and we talked about this in previous shows, that the U.S. fiscal crisis, in other words, this issue around U.S. federal government deficits, debt, and inflation, the doom loop, as I called it, will immediately bleed over into the banking sector and all other financial institutions. So let me close this out, stop the share here, and just say that we are in a very perilous time, and I don't feel great about where we are in 2024 and the likelihood that things are going to be fine. We do not have a Goldilocks economy in this story. Goldilocks doesn't live happily ever after. She gets eaten by the bears on one side or the other. And I think that's almost inevitable. I think, as I said at the beginning, a soft landing is a fairy tale. It's told by liars, and it's believed upon by fools. As an investor, whether for your own money or on behalf of others, it is a time to take care, to take cover, to preserve and to protect, and to watch very closely over the next 2 to 3 months to see how this all plays out. Thank you for being with me today. Please, as I mentioned, if you're watching this on YouTube, give it a like, share it with others, subscribe to my YouTube channel, and you can get a copy of this presentation by just emailing us through stormwalladvisors.com or just email hello@stormwalladvisors.com, and we'll be happy to share it with you. Have a great rest of February 2024, and we'll be back in March with an update on where we stand.